Berlin. Today we are going to focus on New Zealand and the investment immigration opportunities there. So New Zealand has this program called the Active Investor Plus Visa Program. I mean, a lot of people know about this program in the sense that they always consider this as a very expensive program. We're going to find out in this episode whether that is really the case and what are the benefits if one puts so much amount of money in that program. Do you get the dividends for it? To help us explain this program, the details about how one can become eligible for it, I have a very special guest today in my show. His name is Simon Laurent. He's the principal at Laurent Law Barristers and Solicitors. He's joining us live from Auckland, where the Women's World Cup is also taking place. Thank you so much for joining our show today, Simon.
It's a pleasure, Salman. Thank you for having me on.
Thank you. So, Simon, please give us a brief overview of the Active Investor Plus program in New Zealand, and what is the background of it? When did it start? What are its objectives?
Sure. The Active Investor Plus, as they call it, is a relatively new scheme which was opened in September 2022. So that's about 10 months ago as of now. And it replaced a previous system called the Investor One and the Investor Two, which the flagship of that was required a $10 million investment. It was a scheme that started in 2009 and continued what we thought reasonably successfully, but it was mothballed in July of 2022. And this new scheme was then brought out a couple of months later and marks a significant departure in the way that it operates. The objective, according to the immigration instructions that are related to it, is essentially to encourage investors from overseas to participate in the New Zealand industry by its name, in an active fashion, and to bring a significant contribution to New Zealand, quote unquote. So that's the aim of it, and it is directed towards encouraging investment, not just in things like stocks and bonds, but actually investment in companies, in organizations that do things, that generate wealth. So that's the government's aim in opening this up so far, I could say, but the take-up on it has not been that rapid, so there's plenty of opportunity for people to make out those applications and take up the opportunity of residence.
Right. And Simon, if you could explain to us, you mentioned just now that it's a departure from the previous program that we had. So what is the difference now in this program compared to the previous version of it? And how big is that departure from the previous program?
Beforehand, it was a simple matter of bringing a certain sum of money into New Zealand, investing it in pretty much what you wish to put it into, of a nature of something that would generate a commercial return, and leaving that sum of money here for 3 years or 4 years, depending on which category you went under. This one also is time-based in the sense that sum of money needs to be brought in and invested for 4 years in total, tied up in New Zealand for that period. But the difference here is that the way in which people can invest is much more tightly controlled. And there are several classes of investment that one can make, going from buying shares in listed companies, which is seen as more of a safe investment, and so you need to put more money in, up to what is described as direct investment, which is investing in companies which have been identified as suitable by the government. And these are companies that are not publicly traded. There is obviously a certain amount of risk attached to trading in such companies, but the list of companies that you can invest in is in fact maintained and curated by New Zealand Trade and Enterprise, which is a government agency, so that hopefully some due diligence has been done about the viability of those companies as being an investment target. You can put in a mix of investments in different types of investment class, and you can actually change that mix, which adds a level of complication into the strategy. So there is some flexibility in what one can do, but it is not a straightforward investment approach and requires a bit of thought before going into it and during the course of running that investment. That's the biggest change, I would say, that it's much more of a shifting the levers kind of investment on the part of the potential investor.
So let's now talk about the eligibility criteria for the Active Investor Visa Plus program, and how does it, say, differ from other residency options that are there in New Zealand? If you could explain that.
The main difference, I think, really is the ability to identify that you have funds that you can invest, that they're yours, and that you're able to liquidate those and bring those into New Zealand. That's really the difference between this and other types of visa that people can apply for. There are the usual things such as needing to establish that you're of good health and good character, that you have a certain English standard that is the equivalent of the IELTS 5.0. There is one other requirement which is a little bit different to some of the other categories, and that is the requirement to show that you're a fit and proper person for investment purposes. That means that you don't have a history of having committed fraud, of having become bankrupt, or allowing your companies to have failed. That is a test which is applied as a matter of course in any of the investor categories, and it's probably the same in other countries as well. I can't really comment on that, but there's a significant factor that needs to be identified as a difference here.
I see. And the thing you just mentioned about how one can, these checks about whether your money is coming to the proper channels, the due diligence is right. How does one do that? Is the client going to employ a certain agency in New Zealand to do those checks for them so that they can meet the government requirements? How does this process really work?
Now, what we're talking about, I believe, or your question, I believe, was in respect of the legitimacy of the funds that someone is planning to invest.
Exactly.
Yeah, all right. New Zealand is quite strict on this point. The applicant needs to demonstrate that the funds belong to them. That's the first one, and that the funds have been lawfully earned. Now, the first point about the funds belonging to a person means that they belong to the applicant or the applicant and their partner, if their partner is included. And this can sometimes be a real challenge for a high net worth individual because their funds may be distanced from them for asset protection purposes, for tax purposes, and so on. That is not an acceptable structure for the purpose of this type of application. The applicant actually needs to personally own those funds rather than or the assets, rather than them being held by a trust over which they don't have complete control, or held in a company of which they're only one of the shareholders. Of course, some people have a fairly complex set of structures. If they own a lot of assets, they spread them around. So that is a bit of a challenge for some of the applicants to overcome, and we have to work with them on that. The second point is that about the proving that the person has lawfully earned those funds. And that can involve quite a tracing exercise in terms of the applicant showing how they earned the money to make the money that they are now planning to bring into New Zealand. So that, for example, they might need to show that they have traded on the stock market and have built their portfolio, and that can require going back over a number of years of trading history. They may need to show tax returns of companies that they have operated to show that those companies have been profitable, and that's how the wealth has been generated. Again, it can be quite a lengthy exercise of going back over a number of years to show the history which has led to the point where someone has X million dollars available that they can transfer to New Zealand.
Right. And talking about millions of dollars, I mean, let's talk about the minimum investment requirements for the Active Investor Plus program. And if you could explain that amount that one has to have. Also, if you could explain why, this is a question that a lot of people ask about the New Zealand's program. Why is the investment threshold so high compared to so many other countries? What's the logic behind this? So just the type of acceptable investments under this program.
The starting point is that someone is required to invest 15 million New Zealand dollars. That's the equivalent of about 9 or 10 million US or about 9 million euros, something of that ilk. But that is just the starting point. And this is where the different classes of investment become important. If you play it safe and you buy entirely into shares on listed companies on the New Zealand Stock Exchange, then you will need to bring over $15 million. The other extreme is if you decided to invest entirely in what's called a direct investment, which is a privately held company which has been identified as suitable for investment by New Zealand Trade and Enterprise. In order to carry out an investment solely made up of that, you only need to bring 5 million New Zealand dollars, or about 3 million US. There are gradations between that. And just going back to this, there's a weighting system applied so that $1 of the direct investment into a private company is equivalent to $3 bought into shares, public shares. In between that, you have another class, which is the managed funds. These are like unit trust fund investment programs. And the way those work is that every $2 spent in investing in one of those managed funds is equivalent to $3 of the public share purchase. So the idea here is that the more you go towards the active investment, that is the direct investment into a private company, and the more risk that's attached to that, the less money you need to invest. So we have a scale between 5 million minimum to 15 million minimum. And the thing is, you could decide to develop a portfolio which is a mixture of those. One of the other classes is investment in philanthropic, charitable investments. There is a cap on how much you can invest in that, but it might suit some people who feel that they want to fulfill one of their ESG requirements to demonstrate that they're taking a socially conscious approach to their investing. You have these 4 classes and they have different weightings attached to them. And people may decide that, for instance, they're going to partially invest in the privately held New Zealand companies, which are at a higher risk level, and they might put a few million there, and they might put the rest into a portfolio of managed funds. They need to put more into the managed funds proportionately than they would for the active investment, but there might be a certain amount of reduction of risk in doing so. So the answer to your question is not straightforward. And that's one of the things which is possibly might be a disinclination on the part of some potential investors in looking at this and saying, gee, this is a bit complicated to me.
Exactly. And also a lot of questions that I see about the program online is this constant comparison that, hey, it's maybe too expensive, maybe I have better options in some other country nearby. Does that make your job a little bit more difficult to convince clients, or you get clients who are dead set on investing in New Zealand anyway, so they just look at the options and see what's best suited to them and they just go for it?
I don't think an investor invests in New Zealand for a commercial return. They invest in New Zealand because of the opportunity to live here. There's going to be a certain tranche of potential investors who might not wish to put their money into New Zealand because they feel like it could be a risk for them. Then there are other investors who don't care. They have the funds that they can spend basically as a way of, it doesn't sound very nice, but purchasing the security of being able to potentially live in New Zealand in the future. And there are some arguments in favour of doing so. One of them is that New Zealand is, compared to a lot of other countries, a very safe place to live. And it is relatively free of corruption. The social institutions are stable by comparison with some other countries that one could name. And the environment of the country, in terms of the physical environment, is pretty clean. So we have some advantages in terms of lifestyle, in terms of social cohesion and so on, which make New Zealand an attractive place to consider. One of the other things that has occurred to me recently is that New Zealand could well become a very attractive destination for people who are concerned about the dramatic effects of climate change around the world. Geographically, New Zealand has an advantage because of the fact that it sits in the middle of a very significant heat sink, the Pacific Ocean, so that the more dramatic and extreme effects of climate change mitigated around New Zealand. And that, I think, is going to become much more significant as the years pass, especially with some of the things that one has been hearing about what's been happening in the Northern Hemisphere, the larger continental land masses. And I think that's actually something that people should factor into their considerations about where they might want to make a future. I'm not sure if that answers your question, but it certainly, I think, is come back to my point that as far as a commercial investment option, New Zealand is not the easiest and it's not the cheapest. But I think there are, for people who are of a high net worth, there are other criteria that they might weigh up in making that decision.
No, those were all excellent points, and especially this point about climate change. I hear this actually point raised in other countries' programs, especially I heard this from countries in Latin America where a lot of people are moving in or interested to move in because of, these climate change considerations by some clients. So that was a good point. Let's also talk about the trends, where, which particular, you listed 4 investment classes. So where most of your clients are putting their money in, is it mostly in direct investments into approved businesses? Is it into the managed funds you talked about? So if you could share some trends in that.
As I said, the policy was only opened in September. The flow of potential investor migrants has been very slow, I have to say, at this point. This is what sometimes happens with these schemes, where it takes a while for the news to get out of what's available and for people to even understand what's involved. We haven't actually seen so far where people are landing their investments. Now, to understand why that might be the case, even though nearly a year has passed, it's necessary then to explain how it works in terms of the timeline of making such an application. And there are several stages to this. So first of all, an applicant puts forward their case and says, I have such and such assets, which I wish to nominate as the funds that I'm going to use to invest in New Zealand. Now that application is assessed, and if it seems to be suitable, then the person is issued an approval in principle letter, which says, these are your nominated funds. You now have 6 months to transfer those funds into New Zealand. Having received that and then having made the arrangement to make the transfer, the funds initially, or most of them, go into what are called holding investments. These are not the final investments, but they are an investment which could even be putting funds into a bank account which has a fixed interest arrangement, and they really are in a holding position from where the funds can then be allocated to the final acceptable investments, and those are the investment classes I was talking about before. The applicant then, from the time that they've transferred all those funds over, then has a total period of 3 years to decide where all of those funds are going to end up. Now, they do need to apply half of the funds into an acceptable investment in the first 18 months after they've transferred the money over. And then the balance has to be finally invested by the end of the second 18 months. So that takes you up to 36 months or 3 years from the time that you've transferred your funds into New Zealand. Now, you can see, therefore, that the timeline is quite long before people actually make their final investments, potentially. Now, they could decide to put all their money into the final investment straight away. The sense of it is that is not what is happening. One of the reasons for that, of course, is the volatility of the economic situation right now. We're looking at relatively high inflation in New Zealand. We're looking at a recessionary environment. Businesses are struggling. And so it is understandable that a lot of investors would be cautious about tying their money up in an investment which they can't necessarily get out of and which could lose money. So the sense of that we're getting at present is that progress in making the final investments is quite slow, and there is a time frame in which that is allowed. So there's not much I can tell you about where those final investments are ending up.
I would like to also understand from you. So you talked about the timeline of this whole process, which could. So what you're saying is, so after 3 years, what happens then after 3 years? Does one get permanent residency once, all the investment is in through this active Investor Plus program? Once you put your money, then after 3 years, what happens? You get permanent residency. What happens then?
Thank you for asking the question, Salman, because what I neglected to mention in my description of the process was that after getting the approval in principle and then transferring the funds, once all the funds are in New Zealand in holding investments or the actual acceptable investments, the resident visa is granted. But the resident visa is, and this is for the applicant and for any partner and children that have been included, so that they are able to be included in that application. Once the resident visa is granted, it comes with a set of conditions which enable the applicant to keep their residence. Those conditions are making the investments, spending a certain time in New Zealand, and keeping those investments in place for a total of 4 years. So you have the first 3 years, which is the time in which, the window in which you have to make the investments, to put them in place, followed by an additional year in which the funds, the assets, need to continue in investment. At the end of the 4 years, the person can then apply to remove the conditions upon their resident visa. And the removal of those conditions means that the person then obtains what is called a permanent resident visa. That is a resident visa which has no conditions whatsoever. And that is really, if you like, the end game. But during the period of investment, they actually do have residence. They're able to come and live here. They're able to come and go from here as a resident.
Right. And they can do that with their families, I assume.
Yes, that's right. Yeah.
Exactly. So after 4 years, for example, if an investor decides to divest or pull their investment, they can do that then?
Yes. After the 4 years, so long as they have kept the funds in those investments up to the point where they ask for the conditions to be removed, they can then divest, they can send their money wherever they like. The reality of it, though, is, and this is from intelligence that I've had from people involved in the migrant attractions sphere in government, the pattern that investors have followed over the years is that they don't just maintain the investment that they've already made, but they will on average invest 3 times as much into New Zealand over the course of their stay in the country. So that, in fact, while some people may pull their money and put it somewhere else, most don't. And they actually put more in because they see, having come to the country, they see, first of all, attractive opportunities for further investment, which they've discovered from living here. and also because they feel that they personally want to invest themselves in the country. So you see a lot of loyalty develop in people who've come here and discover that they like it here.
Yeah, and that makes sense. Once you've put in so much investment of not just money, but time, you would like to invest more there. So that makes perfect sense. But also now, please explain to us what happens after one gains permanent residency. Does it eventually lead to citizenship, and what's the criteria for that?
The residence visa process is handled by Immigration New Zealand. Citizenship is handled by the Department of Internal Affairs, which is a different agency. And the application for citizenship is an entirely separate process. The normal requirement for citizenship for people who've come in as an investor is that they need to have spent a sufficient period of time actually in the country prior to making the citizenship application. And the normal formula is that they need to spend 8 out of 12 months each year for 5 years prior to their citizenship application. Now, if they've decided not to spend that much time in New Zealand during the investment process, then they're going to have to put that citizenship application off. But theoretically, a person who obtained their resident visa initially when they made their first investment and then just decided to spend most of their time in New Zealand from there could apply for citizenship as soon as 5 years after they get their initial resident visa. Not the permanent resident visa, but the initial resident visa. And that's obviously a lifestyle choice. So the length of time it could take to acquire citizenship very much depends on the level of commitment that someone is going to make to living here.
I also want to know from you is the kind of industries or the kind of investor that the government of New Zealand wants to encourage and the kind of investments it wants to encourage. So you mentioned the 4 investment categories. Is there any, out of those categories, is there any category which would give a client a better chance of being successful? Or is that, it doesn't matter really from the government's point of view? Or are they pushing a certain kind of, maybe direct investment that suits them better, and they would want more applicants to apply for that?
The government wants to encourage direct investment into private companies. That is the end game that they're really seeking to achieve with this policy. And the direct investment companies, as I mentioned earlier, are identified upon application by New Zealand Trade and Enterprise as being the suitable businesses that they wish foreign investors to invest in. Now, those could be of all sorts, but NZTE does have a focus on what they call sectors of strength. These are particular classes of industry that they want to encourage. These can be from tourism, obviously, to IT, to partnerships with businesses run by Maori, who are the indigenous people of New Zealand, and forestry, for example. And so those are industrial sectors that they wish to drive, they wish to get investment capital into. And it is probably influencing the decisions on NZTE is making about the types of companies that they are allowing as suitable direct investments. So, for example, an IT company is more likely to be certified as being a suitable company for foreign investment over something else, which is not in one of those sectors of strength. But the only real control that they have over where people make those investments is in the choice of the direct investment private companies and in the choice of the managed funds, which are also curated by NZTE. And those are really fund managers who have a portfolio of New Zealand investment or New Zealand companies that can be invested in. Those can be from all sorts of sectors. So it really boils down now to encouraging investment in private companies, which are in the sectors of strength. Beyond that, I think one of the other imperatives is to try and get foreign investment into the country, foreign funds that are available for use as capital in various different ways. So the amount of control government exerts over that is, I'd say, not as great as they might like.
Okay, noted. And Simon, if you could also tell us, this is also a question that comes up frequently. If an investor is listening to our show in the US right now and, they're interested in investing in a approved business, where do they go exactly? What are the resources to keep in mind in terms of finding, these government approved businesses and these managed funds so that they don't get poor advice or scammed, basically? So if you could share some resources as well, that would be helpful.
Yeah, certainly. All right. So the go-to place for direct investment into private companies is the New Zealand Trade and Enterprise. And that is found at nzte.govt.nz. And someone who's interested in exploring the opportunities can register as an interested party. They can get access to what is called the Live Deals platform. And on this platform, the approved companies can put themselves forward and say, we're looking for $10 million of capital into a startup biotech, for example, or $5 million into a tourism operation in the ski fields. So the investor could then look around at what's available and what they might be interested in and what appeals to them. One of the important things about this is that all of the companies that get to list themselves on the Live Deals platform do go through a due diligence exercise with NZTE first, so that the hope is that if NZTE has done its homework right, these are not a fly-by-night company, these are not a front for something illegal, and these are not businesses that are going to fall over quickly. They need to be sustainable and robust. They need to have a vision for what they're doing. And there's obviously, no absolute guarantee in all of this, of course, because of the vicissitudes of economics and the economic climate. But it is at least a somewhat controlled environment in which investors can look at what to aim for.
And thank you so much for sharing those resources. We are now coming close to the end of our episode. But before I go, I also want to clarify there's a lot of online chatter about maybe, one could buy big properties in New Zealand and maybe have a golden visa route to New Zealand. And if you could clarify for our listeners that, that is really not the case.
Yeah, I can very simply answer that. No, just buying a piece of land is not going to do it. You do have to invest in something which is a going concern. Or we could say the alternative to that is invest indirectly in a going concern by buying into managed funds, into New Zealand companies, or buying shares on the New Zealand share market. But buying land is constrained significantly for non-residents in a number of ways, including the provisions of the Overseas Investment Act, which prevent simple outright purchase in land. It's certainly what could be called sensitive land, which is ecologically diverse. And the purchase of land simply doesn't get you to anywhere in the investment space. It is not an allowed class of investment. Those rumours are unfounded, and they always have been, actually. The exception to that is if one is to purchase into something like a hotel development or a residential property development of a large scale, where one might be able to buy a part share in such a development and provide working capital for the building of that development for commercial return. But even that, I doubtful that that is actually really one of the things that's been advocated for through NZTE. I'd be very surprised if they were driving many of those through that system.
Simon, in the end, I also want to ask you, I read your profile and it was mentioned that you're a specialist in New Zealand immigration law since 1996. So with your depth of experience, I want to learn from you is the kind of future outlook that you have about the immigration space, investment immigration space in New Zealand. What's to expect in the future, you think, and what have you learned since those many years, the kind of trends that are shifting in New Zealand? What can you share with our listeners on that?
I think the overall flavour of how things have gone over the past many years is that the rules around migration and investment migration have become more complex over the years, and they're probably not going to get any easier, I have to say. There are drivers of that, such as the concern about money laundering, illegal flow of money around the world, which has created considerable constraints around people's need to prove the source of their income, for example. The other complexities, I think, are really driven by the way that commerce and people's ways of life have gone over the years, increasing regulation, trying to plug the loopholes, trying to drive social and economic policy to get very targeted outcomes. What that means is that it just makes things more complicated to navigate, certainly much more complicated than when I started. And even the last few years, it's the pace of change and the nature of change has accelerated. So we had, of course, the COVID-19 emergency, which affected everybody around the world. We came out of that about a year ago, and suddenly the doors opened again. A vast amount of change took place in the space of about 6 months, not just in investment, but in other areas as well. There were infrastructure challenges for the government itself to try and deal with all of those changes and cope with them. So we saw things slow down. The implementation of new IT systems made things more complex. And so what I think is going to happen in the next couple of years is that the dust is going to settle. The policies that have been brought in will be left running for a while to see if they're working. Not sure if the Active Investor Plus policy is working. It's too early to tell. It's had a slow start, and it's not clear whether the pace is going to pick up. Of course, we said that about the investor category that was brought in 2009, and that ended up going great guns after a few years. But I think the point is that we could expect that the policy as it stands and the rules around it are probably going to be the same in 2 years from what they are now. And at that point, there might be a reevaluation, but I'd be surprised if much changed before that.
Simon, in terms of the government's approach to attracting investment immigration and investors from around the world, do you see that being encouraged more in the future? And that's what I wanted to learn from you. How has that changed in your experience in terms of, do you think the environment or the opportunities for foreign investors in New Zealand would continue to increase, or this program is going to be the only option on the table for some time, you think?
This is going to be the only option for a little while yet. I don't think there's any appetite for bringing out new schemes. It's too much change that has already taken place. Personally, I don't think that the government has made it particularly easy for investors to apply. They have made a lot of noise about wanting to attract investment, but the reality doesn't quite match up yet. Now, my assessment of that may be too pessimistic, but my feeling is that there is actually scope for creating more attraction than there is at present. And so I'm not sure when that's going to happen. I'm afraid I don't think it's going to happen quickly, which is my previous point, that the rhetoric about encouraging investment into the country is not quite